Welcome viewers to this video. In the previous video, I demonstrated how to prepare consolidated financial statements using the partial goodwill method. But in this video, I am going to demonstrate how to prepare the same statements where we are using the full goodwill method. So I have a question here. This question is extracted from one of the past papers from November 2015, question 5, and this is the CPA Intermediate, the CASNEB exams. So this is what the question says. The following is an extract of the financial statements of A Limited, B Limited, and C Limited for the year ended 30th September 2015. So you are provided with the income statement for the year ended 30th September 2015 for three companies, A, B, and C Limited. And then on the right side, you are provided with a statement of financial position as at 30th September 2015 for the three companies, A, B, and C Limited. And then below, you are given the additional information. Number 1 says, A Limited acquired 40% of C Limited on 1st October 2014 for 700 million. So the percentage of acquisition, 40%, means that the acquired company, that is C Limited, is going to be an associate. Then the second point says A Limited also acquired 80% of the ordinary shares of B Limited on 1st January 2015 at a cost of 30 million. The fair value of non-controlling interest as at this date amounted to 800 million. So according to the statement number 2, we can say that B Limited is a subsidiary because the percentage of B Limited that was acquired is more than 50%. So we have C Limited, which is an associate, and then we have B Limited, which is a subsidiary. And then again in point number 2, since you are given the fair value of non-controlling interest, this means that you are going to use the full goodwill method when you are calculating the goodwill. Then point number 3 says the fair value of B Limited's property, plant, and equipment on the date of acquisition was 210 million, above the book value, with exactly 5 years remaining on the useful life of this property. So you're going to make 2 adjustments here. 1, we are going to increase the value of property by 210 million, which is the revaluation gain. The other adjustment, we are going to calculate depreciation adjustment, because the initial depreciation we assume was based on the older value, which was less, but depreciation is supposed to be calculated on the new value. So you are going to take the 210 million, we divide by the useful life, 5 years, to get the amount of increase in depreciation. Then in point number 4, you are told during the year ended 30th September 2015, B Limited sold goods to A Limited for 140 million. B Limited marked up the goods at 16 2/3% on cost. Half of the goods remained in the stock of A Limited as at the year end. So here we are going to calculate unrealized profit based on the goods that were not sold outside the group of companies as at the year end. So you are told that half of the goods remained in the stock. which means the other half was sold to customers. So unrealized profit will be calculated on the goods that were still in the inventory as at the year end. Then point number 5 says, as at 30th September 2015, A Limited owed B Limited 80 million shillings, while C Limited owed A Limited 15 million shillings. So this is called intercompany debt, and we are supposed to eliminate intercompany debt between the parent and the subsidiary. For the associate, we do not make any adjustments because we don't consolidate assets and liabilities of associate to those of the parent. So in this case, A Limited owed B Limited 80 million, and B Limited according to point number 2 was acquired 80%, which means that is the subsidiary. So you're going to make the adjustment between A and B Limited, but C Limited owed A 15 million. C Limited is an associate. We are not going to make any adjustment for the associate. Then point number 6, you are told goodwill was impaired as follows: B Limited 25% and C Limited 10%. Required, prepare the following financial statements in the books of A Limited for the year ended 30th September 2015. A. Consolidated statement of comprehensive income. B. Statement of changes in equity. And C. Statement of financial position. And then you have the total marks. The total is 20 marks. So the first step when you have a question like this is usually to calculate the percentages of holding. But since we are given the percentages of holding for both companies, 40% and 80%, we are not going to go to that step. So we are going to proceed to calculation of goodwill in subsidiary and also in associate. So because we were given the fair value of non-controlling interest, we are going to be using the full goodwill method. But before we calculate the goodwill, the first thing is usually to find pre-acquisition profit. So what is pre-acquisition profit? This is the profit the subsidiary had as at the date of acquisition, the accumulated profit as at the date of acquisition. So let us check the date of acquisition. So in the question, you are provided with the date of acquisition of subsidiary. We are going to start with the subsidiary. According to the second point, you can see that the date of acquisition was 1st January 2015. That is when A Limited acquired B Limited. So we want to know whether the acquisition was done in between the current financial year. So when does the financial year begin and end? If you go to the required part, we are required to prepare statements for the year ended 30th September 2015. So if the year is ending on 30th September 2015, it means it began 2014 1st October. That was the beginning of the current financial year. So if B Limited was acquired on 1st January 2015, we can say that B Limited was acquired in between the current financial year, which means there were 3 months from the beginning of the current year to the time when B Limited was acquired. So acquisition date was 1st January 2015, and then pre-acquisition profit is the accumulated profit of B Limited up to 1st January 2015. How do we find that? So first, we want to get the retained profit brought forward. That is, as at the beginning of the year, we have said that the beginning of the year is 1st October 2014. So we want the profit as at that date, as at 1st October 2014. So let us see whether we are provided with that from the question. So we go to the income statement for the current year. At the bottom, you are given retained profit brought forward. These are the profits as at the beginning of the year. We are interested with B Limited, which is the subsidiary. Their profit was 1452. That is the balance brought forward. 1452 as at 1st October 2015. So we want the profit part between this date, 1st October, up to the date of acquisition, 1st January 2015, because that is what we are missing. So this is how we are going to find it. Profit between 1st October 2014 to 1st January 2015, because these are 3 months. The period between the beginning of the year to the date of acquisition is 3 months. So you are going to take the profit made in the current year, and then we multiply it by 3/12. So what profit did B Limited make in the current year? So we go to the income statement. The column of B Limited, check for the profit for the period. Profit for the current period is 2152. That is profit after tax, but before anything else, before the dividends, if the dividends were there, that is 2152. So we want to take 3 months. We assume that the profit accumulated evenly. Since this profit is for 12 months, to get the profit for 3 months, we take 3/12 multiplied by that profit, 2152. It will give us 538. So 538, we are going to add it to what we had before. That was the retained profit brought forward. So therefore, total pre-acquisition profit, it is the sum of those two. The profit as at the beginning of the year plus the profit for the first 3 months in the current year. That gives us a total of 1990. So that will be the pre-acquisition profit in subsidiary. That is the one we are going to use to calculate the goodwill. So this is the format for computation of goodwill in subsidiary using the full goodwill method. So why are we using the full goodwill method? Anytime you are given the fair value of non-controlling interest, you are supposed to use the full goodwill method. According to the point number 2 in the additional information, we were given the fair value of non-controlling interest as at the date of acquisition was 800 million. As long as you are given that, the fair value of non-controlling interest, it means you are supposed to use the full goodwill method. And when you are using the full goodwill method, we don't take the parent share because this is goodwill for the entire company, for both the parent and the minorities. So if you know the format, for the cost of control, that is what we are doing here. Although we are not using the T format, we are preparing it in form of a statement, but these are the same items we have in the cost of control account. So we start with the acquisition cost. This is the price the parent paid to acquire the subsidiary, and it is provided in the question. That was statement number 2. There you can see the cost was 3430. That is what A Limited paid to acquire 80% of B Limited. So 3430 is taken to the computation of goodwill as the acquisition cost. And then we also take the fair value of non-controlling interest. the 800, we add the two of them. Then we want to deduct the fair value of net assets in subsidiary as at the date of acquisition. So net assets, this is something that you understand from financial accounting. Net assets means total assets minus total liabilities. It is the same as capital. So in the consolidation process, we normally take equity items as the net assets because net assets is equal to the capital. So we go to the question and look for items classified under equity and reserves for the subsidiary. So we go to the statement of financial position. We look for equity. We have the capital and reserves. All the items under capital and reserves represent net assets and should be included in computation of goodwill. We are interested with B Limited. So you go to the column of B Limited, which is the subsidiary. You take the ordinary share capital of B Limited, 1600. Take the share premium, 300. And because we are using the full goodwill method, we are not going to multiply them with the percentage of the parent. We are going to take them the way they are. So we take the 1600 and 300 to our computation of goodwill. So ordinary share capital, we have 1600 from subsidiary. Share premium, we have 300 from subsidiary. But when it comes to profit, we are not going to take the profit provided in the statement of financial position, which was 3604. Instead, we use the profit that we have calculated above, which is called the pre-acquisition profit, which we have found to be 1990. So that is pre-acquisition profit, 1990. So we have taken all items under equity, except for one thing, which is revaluation, because revaluation, although it is an item of equity, it was done as at the time of acquisition, and it was not included in the equity section. So you go to the additional information, you check for the amount of revaluation, and this revaluation must be in the assets of the subsidiary. So if it is the assets of the parent, then we would not be including it. So in number 3, we are given the increase in revaluation, which is 210 million. That was the gain in revaluation. So this 210, we are going to take it to our computation of goodwill under the fair value of net assets. So when you add these items, they will give you 4,100. You deduct 4,100 from 4230, you're going to find that the goodwill is 130. So this goodwill does not belong to the parent only. It belongs to the entire company, B Limited, which means the minority also have a share of that goodwill. So next, after finding the goodwill, we want to see the information provided concerning the goodwill impairment. In the question, point number 6, for B Limited, we were given the rate at which goodwill was impaired, which was 25%. So we are going to take the goodwill we have calculated, 130, then we are going to multiply it with 25%, and it will give us the goodwill impaired of 32.5. So this is the accounting treatment for goodwill impaired. We are supposed to debit group profit and loss with the share of the parent, which is 80% of 32.5, giving us 26. Then we debit minority interest with the share of minority, which is 20%. So 20% of 32.5 will give us 6.5. And then we are going to credit goodwill account with the whole amount. So the whole amount is 32.5, which was 25% of 130, and that is what we have here, 25% of 130, giving us 32.5. So 100% of the goodwill impaired is going to be credited to the goodwill account. And then the goodwill to be recorded in the statement of financial position is the amount of goodwill itself. You deduct the goodwill impaired. So the remaining amount of 97.5 is going to be shown under non-current assets as the value of goodwill. So next, we are going to calculate the goodwill in associate. So goodwill in associate, we are supposed to follow the same format as we have used when calculating the goodwill for subsidiary. We start with the cost of investment. The 700 is supposed to be given in the question. That is in statement number 1. We are told that A Limited acquired 40% of C Limited for 700 million. That is the cost of acquisition, 700. And then take the fair value of assets acquired. These are the equity items in the statement of financial position of C Limited. So we go to the question, we go to the statement of financial position, we go to capital and reserves. We want the items in the last column of C Limited. We start with ordinary share capital, 400. C Limited does not have share premium, but for the retained profit, we are not going to take this one. We will take the pre-acquisition retained profit. So we record the ordinary share capital. We take the share of the parent, 40% of 400. And then the pre-acquisition profit. This is something you are supposed to find from the question. So if you go back to the question, first, look at the date. Look for the date when C Limited was acquired. The date when C Limited was acquired, it was on 1st October 2014, and this is the date we said is the beginning of the current financial year. So this is the beginning of the current financial year, which means if we can get the profit as at the beginning of this financial year, we have the pre-acquisition profit. So that profit is given directly in the income statement for the current year. In the column of C Limited at the bottom, we are given the retained profit brought forward. This is the retained profit as at the beginning of the current year, which was 1st October 2014, and the amount was 1250. So we don't have to do any workings there. So we just take this 1250 as the pre-acquisition profit. So 1250, you multiply by the share of the parent, 40%. That is the one that gives you 500. So 160, you add 500, it will give you 660. 700, you deduct 660, you will get the goodwill is 40. And then the rate at which the goodwill is impaired is also given in the question. That is in point number 6. Goodwill was impaired as follows. C Limited 10%. So that 40 million shillings that we have found, we are going to take 10% of it to be the goodwill impaired. So it is going to give us 4. And once we have 4, these are the double entries that we are going to make. First, we are going to debit group profit and loss with 4. And then we are going to credit investment in associates with 4. So there is something here you are supposed to keep in mind, that goodwill in associate is not shown as a separate item in the statement of financial position. Instead, it is part of investment in associate. account. So we are going to prepare that account later. So now that we have the goodwill for the two companies, the subsidiary and the associate, we can start by preparing the consolidated statement of profit and loss. So this one is a bit easier to prepare. Remember, you only need to add the income and expenses of subsidiary to those of the parent. We are not going to consider the associate during the consolidation process until the last part where we are going to be taking the profit from associate. So we have the steps here. The first thing, we are supposed to add income and expenses of the parent to those of the subsidiary. The second thing, if acquisition took place in between the year, we are supposed to apportion income and expenses of the subsidiary pro rata to time. So in this case, acquisition took place in between the current financial year. The specific date, if we go back to where we did the workings for pre-acquisition profit, the acquisition date was 1st January, and this was 3 months. This was 3 months after the beginning of the current year, which means the parent and the subsidiary were together for 9 months before the end of the current financial year. So all the income and expenses of the subsidiary, they are going to be apportioned. We are going to take 9/12. We multiply by the income and expenses of B Limited. For example, when it comes to revenue, you're going to take the revenue of the parent, 9120. You add to the revenue of the subsidiary, 4940 multiplied by 9/12. So that is what we have done here. Revenue of the parent, 9120. We add 9/12 of revenue of the subsidiary, and that is how we get the total amount there. We do the same for cost of sales. We do the same for all the other expenses. So once you have apportioned and you have done the additions and subtraction until the point where you have profit after tax, next you are supposed to add share of profit from associate after tax. So go to the question, look at the profit the associate made after tax, then the parent is supposed to take 40% of it. So this is the income statement. Go to C Limited. The associate made a profit of 1888 for the current year. That is the profit after tax. So the parent will take 40% of 1888, which is 755.2. From there, we less minorities' share of profit. So the minorities claim 20% of the profit made by the subsidiary. The profit made by the subsidiary in the current year after tax is provided in the profit and loss statement from the question. So profit for the period, this is after tax, for B Limited was 2152. So the minorities are going to claim 20% of this profit. So we go back to the profit and loss. The minorities will take 20% of 2150, and then they're going to apportion it according to the remaining number of months, because the minorities were there for 9 months since the time of acquisition. So this will give us 322.8, which we are supposed to deduct. So you're going to take the profit after tax, add share of profit from associate, less minorities' share of profit, and the balance that you will get there is going to be the profit attributable to the parent company. This is going to be taken to the group retained profit account, but in this case, the question requires you to prepare a statement of changes in equity. So that is the one that you are going to prepare instead of the group retained profit, although you just use the same format in both of them. So let us go to the workings, some of the workings that we need to make. So generally, we normally prepare 4 accounts as part of workings. If you have an associate and a subsidiary in the same question, you always have to prepare the 4 accounts. The first one is to help you to find the goodwill for both the subsidiary and the associate. The second one is to help you find the group retained profits. In this case, when you prepare the statement of change in equity, you are going to get the group retained profit. The third one is the minority interest or non-controlling interest. And the last one is investment in associate account. So those are accounts that we must prepare when we have both subsidiary and associate. Apart from the accounts, we have other workings. Apart from that, we have other workings that we normally do. For example, an idealized profit from intercompany sale of goods, intercompany sale of fixed assets. In this question, we don't have intercompany sale of fixed assets. And then there is the depreciation adjustment. This can be resulting from the gain in revaluation, and it can also result from intercompany sale of asset at a profit, but we don't have that one in this question. We normally have intercompany debts, which we have in this question. In some cases, we have goods and cash in transit, but in this question, we don't have goods in transit or cash in transit. So you're only going to make the workings for what you are given in this question. So we start by calculating the unidealized profit on the intercompany sale of goods. So this is the formula for calculating an idealized profit. An idealized profit is equals to profit margin multiplied by value of unsold inventory. So we can go to the question and find what the profit margin was, and also find what was the value of unsold inventory. So in the question, that information was provided in point number 4. The goods that were sold by B Limited to A Limited, they were sold for 140 million. And then you are told that B Limited marked up the goods at 16 and 2/3% on cost. So because you are given a markup, marked up means this is a markup, not a margin. We cannot multiply a markup with the selling price. So first we must convert the markup into a margin, and then we multiply the margin with the sales value of 140 million. And then once we have done that, we are going to find the proportion of the goods that remained in the stock. Half of the goods remained in stock of A Limited. So an idealized profit is only for half of the goods, not all of them. So half of 140 million is where we are going to have an idealized profit. So the profit markup is, when you put it in a decimal form, it will give you 16.67%. So we want to convert the markup into a profit margin by adding the numerator to the denominator. So 16.67% can also be written as 16.67 divided by 100. To convert markup to margin, we are supposed to add the numerator to the denominator. 16.67 is the numerator. 100 is the denominator. So 16.67 is going to be added to 100. So that will give us 16.67 over 116.67. Then we convert it back into a percentage by multiplying it with 100. So that will give us a margin of 14.3%. So unrealized profit is going to be, first let us find the amount of unsold inventory. Is going to be half of 140, which is 70. And unrealized profit is going to be the profit margin that we have found multiplied by the amount of goods that were not sold, 70. So unrealized profit is going to be 10, that is 14.3% times 70. So once we have the unrealized profit, we want to know how to make the adjustments. And for us to know that, we have to find out which company was selling to which company. So back to the question, you are told that during the year ended 30th September 2015, B Limited sold goods to A Limited. B Limited is the subsidiary, A Limited is the parent. Because subsidiary is the one that sold goods to the parent, the minorities will have a share of the unrealized profit. So we are going to apportion that one. So we are going to make these entries. So these are the double entries where goods are sold by subsidiary to parent. If it was the other way around, parent to subsidiary, we would not have the minorities share. But subsidiary to parent, we include the minorities. So we are going to debit group profit and loss with the share of the parent, 80% of 10, which is 8. We debit minority interest, 20% of 10, which is 2. Then we credit group inventory with the whole amount, which is 10. So once you have the unrealized profit, the next working we are going to do is depreciation adjustment on revaluation gain. So anytime there is a revaluation gain, we normally adjust the depreciation, and the formula you use will depend on what you are given. If you are given the depreciation rate, then you take the rate, you multiply it with the gain in revaluation. If you are given the useful life, then you take the revaluation gain, you divide by the useful life. So if we go back to the question, we want to see the gain in revaluation. This was given in number 3. The gain was 210 million, and the useful life of the asset was 5 years. So we are going to take 210, we divide by 5. So 210 divided by 5 is going to give us 42, and because we have 9 months, we are going to apportion this expense the same way we have been apportioning all the other expenses, by multiplying 42 with 9 over 12 to give us 13, that is 31.5. So once we have the depreciation adjustment, the entries we are going to make are as shown here. So if the asset belonged to the subsidiary, then minority must be included. But if the asset belongs to the parent, then we don't consider the minority. So we are going to debit group profit and loss with the share of the parent, 80% of that 1.5, which will give us 25.2. Then we are going to debit minority interest, 20% of that 1.5, which will give us 6.3. And then we are going to credit property, plant, and equipment with the whole amount, that 1.5. So those are the workings for depreciation adjustment. We are going to be making those changes as we go to the statement of change in equity, minority interest, and the statement of financial position. So the next working we have is an account known as a statement of change in equity. So this is the same as a group retained profit. The same format we use for group retained profit can also work here. But because it is a statement, we have not used the T format. We have just used one column for the amounts. But the format is the same. The items are the same as the ones we include in the group retained profit account. So we start with the retained profit balance brought down for the parent only. You can be able to do these workings because this is the profit as at the beginning of the current year. If you are not given directly in the profit and loss statement, you can calculate it yourself. So if you go to the question, you will find that the retained profit brought forward for the parent was given at the bottom. That was 5812. 5812. So 5812 is what we have here. But assuming that you are not given 5812, then you can do this working here, which will also give you 5812. So if you go to the statement of financial position, go to the equity section, you take the retained profit of the parent, which is 8237. That is the accumulated profit as at the end of this year. Deduct profit that the parent made for the current year only, profit for the period 24-25. If you deduct this one from the one in the statement of financial position, you are going to be left with the one they had at the beginning of the year, 5812. So that is the working that has been shown here. Take the amount in the balance sheet, deduct the profit retained in the current year, you get the profit retained as at the year beginning. From there, add profit attributable to the parent company from your income statement. This is the consolidated income statement, the last figure we obtained. So we go back to the consolidated statement of comprehensive income. At the bottom, we got the profit attributable to the parent company, which was 4471.4. That is the one we use in the statement of change in equity, 4471.4. So from there, add share of post-acquisition profit in associate, excluding current year. We do the same also with the subsidiary. Add share of post-acquisition profit in subsidiary, excluding current year. So we are excluding the current year because the current year's share of the parent has already been included in the profit attributable to the parent for the current year, 4471.4. So because the subsidiary was acquired in the current year, we don't have any post-acquisition profit except the one that is already included in this figure of 4471.4. As for the associate, if you want to know whether they have any other post-acquisition profit except the one included in the current year, just check the date of acquisition. If you go to the question, point number 1, you will see that the associate was acquired on 1st October 2014. This is the beginning of the current financial year. So all the post-acquisition profit of the associate began on 1st October 2014. So it is only the profit for the current year which is the post-acquisition profit, meaning we don't have any other profit except the one they made in the current year. That is why we have zeros here. So you add these items, 5812 plus 4471.4. The total will give you 10283.4. These are the items we would normally record on the credit side. If you are preparing the group retained profit, these items would have been on the credit side. And then the other items at the bottom would have been on the debit side. So the workings that we have been doing, for example, depreciation adjustments, they are going to be recorded here. So for the depreciation adjustment, if we can go back to the workings, we already found it was that 1.5, and then we took the share of the parent 80%, which gave us 25.2. So 25.2 will be taken to the statement of change in equity. So we are going to less depreciation adjustment 25.2. Unrealized profit. We go back to the workings for unrealized profit. The amount was 10, and then we took the share of the parent 80% of 10, which gave us 8. So this is the one we are going to record in the statement of change in equity. Unrealized profit for parent 8. And then we go to the goodwill impaired. So goodwill impaired in subsidiary. So let us see how we got the 26. Because we are using the full goodwill method, this is supposed to be the share of the parent only. So we go back to the place where we did the workings for goodwill. The goodwill was 130, and then the goodwill impaired was 25% of 130, which was 32.5. Then the parent took a share which was 80% of 32.5. That is what gave us 26. So this 26 will be taken to the statement of change in equity. So less goodwill impaired in subsidiary 26. Then goodwill impaired in associate. We go back to the place where we calculated the goodwill in associate. So the goodwill was 40. The goodwill impaired was 10% of 40, which was 4. So we said we were supposed to debit group profit and loss with 4. And that is what we are doing in the statement of change in equity. We are deducting the goodwill impaired in associate, which is 4. So once you add these 4 items, 25.2 plus 8 plus 26 plus 4, they will give you 63.2. And then you deduct 63.2 from 10,283.4. It is going to give you 10,220.2, which is the retained profit balance carried down. So this figure will be taken to the statement of financial position under the equity section. So next we go to non-controlling interest or the minority interest. So remember, we are using the full goodwill method. So we are not going to show the share of net assets. We are not going to break them down into ordinary shares, share premium, the retained profit. Instead, we just take the fair value of non-controlling interest, which was given in the question. It was given in the question in the second point. The fair value of non-controlling interest was 800 as at the time of acquisition. So that is the one we are supposed to take anytime we are using the full goodwill method. So fair value of NCI 800. So one thing you are supposed to note, a few things you are supposed to note. One, in the full goodwill method, minorities are valued at fair value instead of their share of net assets. That is one thing you are supposed to note. Another thing you are supposed to note, when using the fair value as at the date of acquisition, we do not include revaluation gain as at the date of acquisition because it is already reflected in the amount. Once you have the 800, the fair value, this is already reflecting the revaluation gain, so there is no need of including the revaluation gain again here. The last point you are supposed to note: fair value includes everything that took place from the date of acquisition moving backwards, but it does not include things that happened from the acquisition date to the balance sheet date. One of those things that happened from the acquisition date to the balance sheet date is the post-acquisition profit. Since the post-acquisition profit is not included in the fair value of NCI, we have to add it here so that we can get the fair value of NCI as at the end of the current financial year. This is the value as at the time of acquisition, but we want the value as at the end of the current financial year. So we add the share of post-acquisition profit in subsidiary, and this is something that is derived, it is obtained from the consolidated income statement. If you go to the consolidated income statement, there is a part where we deducted the minorities' share of subsidiaries' profit. The amount we got was 322.8. This is the profit the minorities shared in the current year. So that is the one we are adding here, 322.8, because all of it is post-acquisition. It was gained after the date of acquisition. Then on the debit side, we are going to show the same items we had in the statement of change in equity, but now we are just going to take the share of the minority. For the depreciation adjustment, we take the minority's share. Depreciation adjustment, minority's share is 6.3. So that 6.3 is what we have here. And then we have unrealized profit, minority's share. So we want to see where the two came from. We go back to our workings. So for the unrealized profit, the minority's share was 20% of 10, which is 2. That is how we got these two. For the goodwill impaired, this is the share of the minority. So we go back to the goodwill. The goodwill impaired minority's share was 20% of that 32.5, which was 6.5. And that is what we have here, 6.5. So these are all the adjustments that affected the minorities. So the balancing figure is 1108. 1108 will be taken to the statement of financial position under capital and reserves. So the next working is going to be investment in associate. So this one is a very easy account to prepare as long as you know the format. On the debit side, we normally start with the cost of investment, and the cost of investment is given in the question. That is in point number 1, the cost of investment was 700. So you bring the 700 in this account. Next, you add the share of post-acquisition profit. Post-acquisition profit is the profit for the current year only, because the associate was acquired at the beginning of the current year. Therefore, this 755.2 is the same profit we had in the consolidated income statement. The part where we said, add share of profit from associate, 40% of 1888, it gave us 755.2. This was our post-acquisition profit. We don't have any other post-acquisition profit from associate. That is the one we have here. And then on the credit side, we record the goodwill impaired, which is 4. The balancing figure gives us 1451.2. This is going to be taken to the statement of financial position under non-current assets. So we are done with all the workings, with all the accounts. The remaining thing is to prepare the consolidated statement of financial position, which is prepared by the parent. So at the top, you use the name of the parent, A Limited. And then the consolidation process is very easy. Consolidate the assets and the liabilities. Do not consolidate capital and reserves. It is as easy as that. So you are going to the original statement of financial position that was given in the question. You are going to add the assets of the parent to those of the subsidiary. And then you're going to consider the workings we were doing all along, see which ones are going to affect the assets and the liabilities. So going back to the original statement of financial position, under non-current assets, we had property, plant, and equipment. The parent had 6096. We are going to add this to that of B Limited, 4855. So 6096 we add to 4855, then we add revaluation gain, and then we deduct depreciation on the revaluation gain, the whole amount, not the share of the parent, but the whole amount, and this is the total that we get. And then we have investment in associate. Investment in associate, you take the balancing figure from the investment in associate account. The balance carried down was 1451.2. That is the one we bring here, 1451.2. And then we have other investments. So where do other investments come from? So let us go back to the original statement of financial position to find out. So in the statement of financial position, there was investments. The parent had 4350, the subsidiary had 50. We are supposed to add the parent's amount to the subsidiary's amount, and then we are supposed to deduct from the parent's amount the cost of investing in B Limited and the cost of investing in C Limited. The cost of investing in B Limited is given in the additional information number 2. It was 3430. The cost of investing in C Limited was 700. So these two figures have been included in this amount 4350 in the parents column. So during the consolidation process, we are supposed to deduct them, and then whatever remains becomes other investments. That means other investments apart from C and B. So that is what I did here. So other investments, you take the investments of parents. First, deduct the cost of investing in an associate. Then deduct the cost of investing in subsidiary. And then add the investments found in the column of the subsidiary. The amount you're going to get is 270. So that is how we did the workings. And then the goodwill. This is the goodwill for the subsidiary only. We do not show the goodwill in associate in its own separate line, or we don't even combine it with this one of the subsidiary because it has already been reflected in this figure of investment in associate. So this is the goodwill in subsidiary. The amount was 130. You're going to deduct the goodwill impaired 32.5, and that is something we had done here. So the balance is supposed to be 97.5. So 97.5 is what we have here. Next, we go to current assets. We have inventories. In inventories, we are going to add the parent and the subsidiary, and then we deduct unrealized profit, the whole unrealized profit, which was 10. So in the original statement of financial position, we had inventories. The parent had 1460. The subsidiary had 853. So in the consolidation process, we add 1460 plus 853, and then we adjust for unrealized profit. That is what we get. Next, we have accounts receivable. If we have intercompany debts, we are supposed to adjust them in accounts receivable as well as in the accounts payable. In this case, we had intercompany debts between the parent and the subsidiary. A Limited, which is the parent, owed B Limited 80 million. So to A Limited, 80 million is an account payable. It is a liability. To B Limited, 80 million is a receivable. It is a current asset. So because it is an asset and a liability at the same time, during consolidation, we eliminate the 80 million. So we take the accounts receivable of the parent 1880, we add to that of the subsidiary 765. 1880 plus 765, then we deduct intercompany debt 80, then we get the amount. Cash and bank balances, we take the parent's amount 1224, we add the subsidiary's amount 187, 1224 plus 187, we get the total. And then when we go to capital and reserves, we do not consolidate anything here. Capital, share capital and share premium, we take the amounts of the parents only. 2600 and 1500, that is supposed to be the capital of the parent. We don't add that of the subsidiary. So if you go to the original statement of financial position, the ordinary share capital of parent was 2600. The share premium of parent was 1500. So 26 and 15 is what we have here, 26 and 15. From there, you have to include retained profit. So we don't consolidate retained profit. Instead, we take the balance you found in the statement of change in equity. That is the one you're supposed to bring here, 10,220.2. So if we go back to our statement of change in equity, the last amount we got was 10,220.2. That is the one we brought here. And then you're supposed to include minority interest in this section. This amount is supposed to come from the minority interest account, 1108. We go back to the minority interest account. The balance carried down was 1108. That is what we brought here. Then we go to non-current liabilities. In the original statement of financial position, we had loan from bank. The parent had 650. The subsidiary had 200. In the consolidation, we add 650 and 200. It gives us 850. We go to current liabilities. The parent had trade payables of 1463. The subsidiary had 646. So during the consolidation, we add 1463 to 646, and then we deduct the intercompany debt. We get the total. Current tax. The parent had 560. The subsidiary had 360. You add those two, 560 plus 360, you get 920. So the total for capital and reserves and all the liabilities is giving us 19,227.2. And then the total for all the assets, non-current and current, gives us 19,227.2. So as you can see, the two totals are equal, which means our workings were correct. So that is the end of this video. Thank you for watching. If there is a question you would like me to demonstrate, you can leave a comment below. Goodbye for now.